Crypto has grown into a trillion-dollar industry. But in the United States, one huge problem still exists. Nobody fully agrees on the rules. Some regulators say crypto is a security. Others say it's a commodity. Some companies get sued, while others operate with almost no oversight. And because of that confusion, billions of dollars, crypto companies, and innovation have been leaving the United States. Now, lawmakers are trying to change that with a new crypto regulation bill, often referred to as the U.S. Crypto Act or the Clarity Act. And this bill could completely reshape the future of crypto in America. So what exactly is it? And why is everyone talking about it? Let's break it down simply. First, understand the biggest issue in crypto regulation. Right now, there's no clear legal definition for many digital assets. That's why regulators have spent years fighting over who controls crypto. The two biggest agencies are the SEC, the Securities and Exchange Commission, and the CFTC, the Commodity Futures Trading Commission. The SEC usually regulates investments like stocks and securities. The CFTC regulates commodities like gold, oil, and futures markets. But crypto sits in the middle. Bitcoin is generally treated like a commodity, but many other crypto projects raised money from investors, like startup companies. So regulators started arguing, are these coins investments, or are they decentralized digital commodities? That uncertainty created lawsuits, fear, and confusion across the industry. And that's where the U.S. Crypto Act comes in. The main goal of the bill is simple. Create clear crypto rules. Instead of forcing every cryptocurrency into the same category, the law creates different classifications for digital assets. Under the proposal, truly decentralized cryptocurrencies could be treated as commodities under the CFTC. Crypto projects controlled by companies or teams raising investor money could fall under SEC oversight. In simple terms, the more centralized a project is, the more likely it becomes regulated like a traditional investment. The more decentralized it becomes, the more likely it is treated like a commodity. That distinction is one of the biggest parts of the bill. Because for years, crypto companies claimed they didn't know which rules applied to them. The bill also targets crypto exchanges. Platforms that allow people to buy, sell, and trade cryptocurrencies may have to register officially and follow stricter compliance rules. That includes things like customer protections, anti-fraud systems, transparency requirements, reporting obligations, and market surveillance. The idea is to make crypto platforms operate more like regulated financial institutions. Supporters say this could reduce scams and increase trust. Critics say too much regulation could hurt innovation and make it harder for smaller crypto startups to survive. Another major focus is stablecoins. Stablecoins are cryptocurrencies designed to stay tied to assets like the US dollar. Examples include USDT and USDC. The government wants stablecoin companies to prove they actually hold enough real reserves behind their coins. Why? Because if a stablecoin collapses, it could create massive panic across the crypto market. We already saw this happen with Terra Luna in 2022. Billions of dollars disappeared almost overnight. So lawmakers want reserve requirements, audits, and more transparency. Supporters believe this protects users and strengthens confidence in crypto. Critics worry it gives governments too much control over digital money. Now, here's why this bill matters so much. If clear crypto laws finally exist in the United States, large institutions may feel safer entering the market. That could mean more banks offering crypto services, more investment firms buying digital assets, more companies building blockchain technology, and potentially more money flowing into the crypto industry. Some investors believe regulation could actually help crypto grow faster by making the market appear more legitimate and stable. But others believe heavy regulation goes against the original purpose of crypto. freedom from centralized control. And that's the real debate happening right now. Should crypto become part of the traditional financial system, or should it remain outside of government control? There's also another important point many people miss. This bill doesn't mean crypto becomes safe. Regulation cannot eliminate volatility. Bitcoin can still crash. Projects can still fail. People can still lose money. The law mainly focuses on creating legal structure and accountability, not guaranteed profits. And that's important to understand. So, what happens next? If lawmakers continue supporting crypto legislation, the United States could finally establish a long-term framework for digital assets. And if that happens, it may become one of the most important moments in crypto history. Because for the first time, crypto would move from a loosely regulated experiment into an officially recognized part of the financial system. And whether you're bullish on crypto or completely against it, that changes the future of money forever. Crypto is evolving fast, and the people who understand regulation early may understand where the industry is heading before everyone else. If you enjoyed this video, subscribe for more content about crypto, investing, money, and the future of finance. And remember, technology changes quickly, but money always follows the rules. I'll see you in the next video. Peace.